This insight explains how the first interpretation of a trade can become a mental anchor that biases management and ongoing analysis. The problem is not starting with an idea. The problem is allowing the first idea to remain central after price action has already provided enough reason to weaken, revise, or abandon it. Anchoring to the initial trade idea starts with something that is normal and necessary. A trader sees a setup, defines a thesis, and acts on it. The trouble begins when the original interpretation keeps too much authority after the market has already provided new information. The first idea becomes a psychological center of gravity. Every new signal now has to orbit around it rather than compete with it fairly. The trader still believes he is adapting, but adaptation has become slow, reluctant, and biased toward preserving the original reading. This anchor is powerful because first interpretations often feel cleaner than later ones. They were formed before money was at risk, before uncertainty became emotional, and before the need to change direction carried any sting. Once the trade is live, revising the original idea can feel like admitting that the first read was weaker than it appeared. Many traders would rather stretch the meaning of new information than loosen their grip on the opening thesis. That is how the anchor survives beyond its useful life. The pattern shows up in management first. The trader keeps expecting the market to behave according to the initial scenario, even when the tape has changed texture. He treats failed continuation as temporary noise, interprets weak reaction as delayed confirmation, and holds on to structural levels that no longer carry the same meaning. In some cases, he adds explanation rather than updating. The story gets more elaborate while the trade gets less honest. The problem is no longer the market. The problem is that the trader needs the first idea to remain more correct than the current evidence allows. Anchoring also damages flexibility outside the active trade. If the first plan was to buy a breakout and the market now trades better as a fade, the anchored trader struggles to flip the lens. He keeps searching for ways to rescue the original direction. This is not discipline. Discipline follows a method. Anchoring protects chronology. It gives extra weight to whatever came first simply because it came first. That is why the trader can stay mentally committed long after the market has stopped offering support. Operationally, the cost is delayed adaptation. Stops are respected later than they should be. Exits become slower, and reassessment loses freshness. The trader is not only trading the market in front of him, he is trading the relationship between the current market and the first explanation he gave himself. That extra layer of loyalty is expensive because it interferes with the one skill management most depends on, which is updating without drama when the evidence changes. A useful sign of anchoring is interpretive asymmetry. New information that supports the original idea feels meaningful. New information that weakens it feels incomplete, early, or untrustworthy. Once that asymmetry appears, the trader is no longer weighing the present evenly. He is defending the original map against the territory. The map may still be partly right, but the weighting process is now compromised. The correction is to treat the first thesis as provisional by design. Before entry, define what would cause the interpretation to lose authority. During the trade, compare fresh evidence against that threshold rather than against emotional loyalty to the opening idea. The question is not whether the initial read was intelligent. The question is whether it is still the best explanation for what price is doing now. If the answer becomes no, adaptation is not betrayal. It is competence. Anchoring weakens when the trader learns to value present evidence over chronological attachment. The first idea matters because it got you into the trade. It does not deserve permanent seniority. A good thesis must keep earning its place as the market evolves. If it no longer can, then releasing it is not a loss of discipline. It is exactly what disciplined reading looks like after the trade has started. This also improves post-trade review. When the trader writes down where the initial thesis should have lost authority, he creates a clean point of comparison between plan and reality. That makes it easier to see whether the trade was managed by evidence or by attachment to the opening read. Over time, that habit strengthens one of the most valuable management skills in trading, which is staying intellectually mobile after entry. The first idea can still be useful, but it must remain something the market can overrule without resistance. One useful correction is to restate the trade in neutral terms after entry. The market does not owe the original idea anything. If structure changes, if timing weakens, or if fresh order flow invalidates the premise, the position has to be managed from current information. That habit reduces attachment and keeps the trader responsive instead of stubborn.